I've been around in the business for 45 years, and I've never seen the opportunities I see now. According to our expectations, truly disruptive innovation, which right now is valued in the global public equity markets at roughly $10 trillion, roughly 10% of the global equity market cap. We believe that 10 trillion is going to scale to 210 trillion by the year 2030. The Fed raised interest rates 50 basis points this week. And I had been saying that I thought that would be a mistake. The markets are corroborating that it seems that the Fed is making a mistake. So we've seen the stock market go through a spasm. The S&P now from its peak is down 15%. The NASDAQ from its peak is down 25%. Pure play innovation strategies like ours are down 60 to 75%. So that's not just a spasm, that's a convulsion. And you'd think that innovation companies that are not in benchmarks are witnessing the end of their world. It couldn't be further from the truth. This is a huge inefficiency in the market, this tendency to move towards benchmarks in risk-off environments. It's ridiculous that the genomic revolution and blockchain technology and crypto assets are all behaving exactly alike. In fact, crypto assets began to correlate highly with the NASDAQ starting at the beginning of COVID. Before that, there was no correlation at all. And so we think this is an anomaly, a massive anomaly, and that with time it will correct and the efficiencies will be introduced back into the market. So that's the stock market. The bond market this year to date, if you use the 10-year Treasury yield and its proxies prior to 1940, year to date through April, and I'm sure even more so through today, the bond market has not seen worse performance since 1788. Think about that. This is like a tsunami and an earthquake together. I used to describe what was going on in the bond market as an earthquake, given the very low base of interest rates from which we started. Now, you might be asking why would that be true, given that the bond market was just a terrible place to invest in the 70s when inflation was taking off? Well, the difference between now and then is back then there were huge coupons. You know, interest rates they were paying were starting at 6, 7, 8, 9%. Whereas during COVID, we got down to 0.5%. So the base from which we're starting is very low. And that's why we now have a tsunami. The 10-year Treasury yield has gone this year from roughly 1.13% to 3.11. Again, huge percentage increase. High yield bonds, their spreads have increased. Now their spreads are relative to that Treasury yield. And so their spreads have gone up from 2.45 to 4.08. So in addition to the 200 basis points or the 2 percentage points that the underlying bond has gone up, they have gone up another 150 basis points. So credit is becoming much more expensive. If you look at credit default swaps, which are very sensitive to stresses and strains in the ecosystem, essentially they're insurance policies that investors take out or speculators take out to protect against some negative eventuality. Those have gone from, if you use the CDX, which is a market, MARKIT, metric based on the 5-year credit default swaps, they have gone from 45 to 46 as of September 21 to 85, 86 as of today. Now, during COVID, they went up to 159, so we're not anywhere near there. During the fear that China was going to blow up in early 2016, they got to 128. Well, that's a little closer to 85, 86. But today, we are much closer to where we were in 2018, the fourth quarter. Now, what is the significance of that? In the fourth quarter of 2018, the market was beginning to send signals that the Fed was overdoing it by raising interest rates each quarter. And so this metric hit 95 then. So we're at 85, 86. So the Fed is beginning to understand that there are stresses and strains out there, and that is why this past Wednesday, the fear that the Fed would raise interest rates 75 basis points, either this go around or next go around, Chairman Powell put to rest and said they were not contemplating it. And so he was considered, he sent, relative to expectations, a positive signal. And all the markets seemed to enjoy a run for that one day based on the notion that the Fed was beginning to understand that maybe they're overdoing it. We think over the next month, now they have another meeting in June, over the next month, we believe that the Fed is going to get a lot of data. Today was one of those days with the employment report that is going to put another measure of caution into their cadence here. So we would be surprised to see another 50 basis point move. Maybe they do 25. We still think they're overdoing it and the markets won't be happy. But I think what's happening here is this Fed and the members of the Fed are so afraid that they will be stuck with the legacy of reigniting inflation and not being able to put the genie back in the bottle. They're so afraid of that they are they're speaking very fiercely right now, and they've made a bold move, 50 basis points, when the base is only 25 basis points. So we shall see. We've seen M2's growth decelerate from 27% to 9.9%. And if you look at it that's on a year-over-year basis. If you look at it on a 3-month moving average basis and annualize that, we're in the low single digits. And it's kind of consistent with what happened in the GDP report. I'll get into that in a moment, but that GDP report was negative.